Welcome to this week's podcast, brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex, stocks and commodities in multiple destinations. I'd like to thank them for the sponsorship of this podcast. I'm Michael Hewson, and joining me again is my good friend, as well as Pepperstone Senior Market Strategist, Michael Brown. So Michael, markets this week, had a slightly better run of it. I think FTSE's up, Sterling's up and bonds are up.
Hello, mate. Yeah, I think that's an interesting combination, actually. We saw the FTSE rally last week, but that was primarily a result of some fairly chunky weakness that we saw in the pound. This week's move, you would say, is a little bit more organic and a little bit more UK driven. But I would caveat that by saying two things. One is that, actually today is, of course, Thanksgiving in the United States, so markets are a little bit thinner than normal. And of course, the second thing is it is the end of the month. And of course, at the end of the month, we see rebalancing flows, to coin a bit of a cliche, and that may be helping to drive the FTSE higher a little bit as well. But nonetheless, we should be happy that the London market is performing a little bit better than it has been in recent weeks.
Yeah, certainly hit a post-budget high, I think on Monday, above 8,300. So, maybe some good news for the government if you just use markets as your sole barometer of investor sentiment. But certainly, I think if you look at some of the broader headlines, not been such good news. But before we dive off into the weeds of what's going on in the markets, I think I better get started with a little bit of a disclaimer. Otherwise, we'll both get into trouble with your compliance department. So the information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 75.1% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so obviously
you almost got through that without stumbling over your words.
Well, almost. Almost. I think I probably need to take a drink. This is just water. It's not gin or vodka or anything like
that. That old chestnut, eh?
That old chestnut, indeed. So obviously you mentioned US markets are closed for Thanksgiving, and consequently trading is thinned out quite a bit and is likely to remain thin. Obviously it's Thanksgiving. We've got Black Friday tomorrow. One of the things that I'm going to have take a quick look at is a couple of articles posted by one of my colleagues, Darren Sinden, on top UK and US stock market discounts or shares that are trading at a discount, which might be worth a look over the course of the next weeks and months. Essentially, they've not had a particularly great time of it. Maybe the time is ripe for a little bit of a turnaround. So obviously that's going to keep us occupied in the beginning. I think as we approach the end of the month and the end of the year, you mentioned that there was a little bit of what I call month-end squaring. It might be useful, I think, if in the upcoming weeks, if we look back on the year, a couple of sectors in particular you might have an interest in sort of having a preview and looking back on.
Yeah, I think that would be useful. I mean, we're certainly in the 2025 outlook season already. My email inbox is sort of bursting at the seams in terms of all the stuff that's been coming out from the sell side. And I think there's definitely value in looking back at what's done well and what perhaps hasn't done so well over the last 12 months. And also looking ahead, of course, I mean, within 20 odd days of the new year getting underway, we're going to have Donald Trump taking the oath of office and making himself at home in the White House, and plenty for markets to digest as we move into the new year as well.
Yeah, I also think it's also a good year it's a good time of year to sort of reflect on what has done well and whether or not the momentum that we've seen from those companies that have done well will continue to do well in the coming days, weeks, and months. Now, obviously, we're talking about trend and momentum here. Obviously, some of the things that Darren's talking about in his UK stock markets discounts this Black Friday in US markets. He's focused on stocks, shares, and investment trusts that are essentially trading or being traded at a discount. He talks about investment trusts discounts to NAV. NAV is net asset value. And I certainly think it's one area of the market that probably doesn't get as much focus as perhaps it might. In my opinion, there's a reason for that, and ultimately because I think it's not widely known about. And what's your view on investment trusts, Michael?
This is a very difficult one without going into the sort of weeds of financial markets. We could talk about this for hours. I mean, I think the fundamental thing with investment trusts is when you look at these trusts and they're trading at a discount to their net asset value, you would say you're buying effectively, let's say, £1 worth of assets for 90p if it's trading at a 10% discount. There are a number of sort of complicating factors with that, though. It is a little bit more complex than that sort of simplistic example would imply, particularly on the regulatory side of things. There's also interest rate risk involved as well. But it's certainly something that perhaps doesn't get the attention that it deserves. A lot of times we're talking about, in the general investment world, we're talking about index funds or tracker funds or even thematic ETFs. Investment trusts do seem to perhaps fly under the radar, and I'm sure Darren has flagged some areas of potential value in his column there.
I mean, he talks about one Polar Capital Technology Trust, which is trading at a discount of 9.3%. What's interesting, though, about that particular trust is what's in it. And if you look at actually what's in the trust, it's got companies like Nvidia, Microsoft, Meta Platforms, Apple, Taiwan Semiconductors, Broadcom, Advanced Micro Devices, which surprises me that it's trading at a discount.
Yeah.
When you consider all of those shares are high performing shares, and when you've got a company like Nvidia, which is up 200% on the year, he does mention that the trust is up, but certainly by no means up on the year, that is, but certainly not to the same extent as, say, for example, Nvidia. So what are the advantages of investing in that as opposed to the actual physical stock itself within the trust? I suppose it's diversification, right?
Well, that's very true. I think the diversification angle is the key one. The one thing I would say is that actually context is very, very important here. And I know we were discussing this earlier in the week, and actually, although we may be trading at a 9% discount to the NAV, I don't have my Bloomberg in front of me to be able to check this. But the key thing is not necessarily what that discount is in absolute terms. It's what that is in relative terms to where that discount has been over the past 5 or 10 years, let's say. We tend to see over time investment trusts naturally trading at a discount to their NAV anyway. So I'm not familiar with this particular trust, but 9% could actually be the narrowest discount that we've seen in some time, for instance.
Yeah, I think you'll find it is. What he says is that the fund is up by almost 41.5% over the last 12 months and has rallied 31.6% year to date, outperforming the Nasdaq 100. So obviously that's one. He then outlines a list of other investment trusts that are trading pretty much at a discount, some 30%, 50%, 40%, 10%. But as you rightly said yesterday, just because they're trading at a discount doesn't mean they can't trade at more of a discount.
Yeah, that is incredibly true. Sorry, you got me on the hop there as I was taking a sip of water.
I'll try and time my interventions a little bit better.
Yeah, please do. But no, you're absolutely right. Just because something is trading at a discount or just because something is cheap on a particular valuation metric, that's absolutely no reason to go, we need to buy it just because of that alone. Something can get cheaper than cheap.
Moving away from investment trusts, we're going to move on to UK stocks trading at price earnings discounts, and he's focused on Jet2, which is interesting, given the fact that obviously it's a budget airline. It doesn't have any southeastern hubs. It's generally it's Bradford based budget airline, serving a lot of the northern airports, Manchester, Glasgow, Edinburgh, Newcastle, and has seen a fairly decent rally so far this year. But if you actually go back to 2020, it really collapsed from very, very high levels to very, very, sort of also multi-year lows in the wake of the COVID pandemic. Actually, looking at the chart, the recovery has actually been quite significant. And consequently, he seems to think that perhaps it might be worth having a look at, given the fact that it's trading on earnings of around about 7.12 times, trailing PE of 7.12 times and a forward multiple of 8.67. The concern I think would have with respect to that is that obviously it's a much smaller airline, and therefore its potential for growth is probably slightly more limited than, say, something like EasyJet, whose numbers came out earlier this week and were very, very good.
Yes, indeed. I mean, EasyJet seemed to have taken off a little bit after that dividend increase that they announced earlier in the week. The thing I think, the other concern I would have with, he's actually brought a yellow card with him this week. For those of you listening, I'm being brandished with a yellow piece of paper at the moment. I'm wondering if there's a red one coming in a second. The other thing I would mention with regards to Jet2 is they are very, very much a leisure-focused airline. And I know this is only episode 4 of this podcast, I think, that we've been recording now. But one of the sort of running themes that we've had is this potential for the UK consumer to be very, very fragile, and for spending to become considerably more restrained as we feel the full impact of the budget, and of course as inflation remains sticky, etc., etc., etc. So it's not as if Jet2 are going to be cushioned by business travel, which demand there remains relatively firm. They are very, very exposed to the leisure sector. So if we do see consumer sentiment continuing to remain relatively dour into the key summer period next year, then perhaps a little bit of turbulence could well be on the cards for them. Well, clearly you don't have a red card because you haven't shown me one. Oh, he does. You've come prepared this week.
I have come prepared this time. So all you listeners who are wondering what we're chuckling about, I have got a yellow card and a red card, and every time Michael makes a really bad pun, it's coming out, and I have a feeling it's going to get quite a bit of use today.
Well, for those of you who follow me on Twitter, you'll be familiar with my excellent use of puns, but we're bringing them to the podcast world now.
I think the jury is out on the adjective excellent, but
I think the jury will be back quite quickly.
Yeah, I'm sure it will be. But you talked about EasyJet, and essentially, I think in their guidance, they suggested they were going to be able to. They were optimistic they could grow capacity by 3% next year. First quarter of 2025, it's 80% booked. Obviously, and the first quarter, in fact, the first half of their financial year is always loss-making, and they tend to make that up in the second half. And they've done that by some distance. And I think a large part of that is down to the fact that EasyJet Holidays is also doing very, very well. I was about to say taking off, and I checked myself because
where are my yellow and red cards? I need to make a set of my own. I think
you didn't come prepared. So yeah, absolutely. I mean, in terms of the future prospects, they certainly look good. But both EasyJet and Ryanair have actually come out recently and said they're going to cut services to UK hubs because of the increase in air passenger duty that's going to kick in 2026. So I think, yes, the prospects do look good, but certainly as far as the UK is concerned, I think they're finding that because their cost base is going up, you're going to find that actually prices could go up and availability could go down.
Mm. Yeah, no, I think you're absolutely right. And I think one thing that certainly myself, and I know probably it's a common theme, is we do forget that actually EasyJet and Ryanair are pan-European airlines now.
Yeah.
They are not solely... Yeah, exactly. Jet2 is very much a sort of UK-centric operation. So again, I mean, if you had and again, this is sort of not investment advice in any way, shape or form, but if you did have a sort of yearning to get into the travel or the aviation sector, I would potentially argue that Jet2 is probably not the way to be doing it. And there are perhaps better options out there, given the risks to the sector here in the UK from the fiscal policies that are being enacted.
When I was looking at the Jet2 share price, basically it dropped from nearly £20 to £2 in the wake of the pandemic. I mean, that's a huge drop. It's now around about 1600. so £16 now. So it's not quite back at its peaks, but it's not far off. But if you compare that to EasyJet, and this is where I struggle a little bit, the rebound in EasyJet's share price has been not even close to its 2020 peaks. Its 2020 peaks are around about £13, and it's now at 554p, so £5.50. So it's not even got close to the peaks in 2020. And actually, even its 2021 peaks, when it was around about 850, 890p, it's well below there. So in terms of what it was worth even 3 years ago, it's not even recouped that. And that was post-pandemic, not pre-pandemic. So, on a valuation basis, certainly EasyJet may be more expensive, but certainly not to where it was in 2020.
Well, I was about to make the same point. As I say, great minds think alike and all the rest of it. Valuation is not the be all and end all of looking at how a stock is performing and how it's likely to perform in the months and years ahead. And I would actually say, particularly with something like the travel sector, which we all know was badly beaten up and bruised during the pandemic, comparing level to pre-COVID price is probably a better way to do things. And that would suggest that there is potentially more upside in something like EasyJet than in one of the more leisure-oriented operators.
Okay, so let's move across the pond. Darren's also looked at 5 US stocks that are trading at significant discounts. He's looked at Walgreen Boots Alliance, has underperformed by almost 93%. Wow. I mean, it's fallen 68%. It's fallen 68% this year. So the mantra about not trying to catch a falling knife, he advises steering clear of that. But he's picked out Moderna, saying it's got a different story to tell. And again, it's undershot the index by 86% year to date. Share price has fallen 61.5% during 2024. He's arguing that the stock is starting to show signs of life. I sort of do have concerns about Moderna, given the fact that obviously Trump is appointing Robert Kennedy as essentially his health secretary, and there are concerns, I think, about the new administration's approach to pharmaceutical stocks. And just because we've seen a decent rally doesn't necessarily mean that we might not fall further. And again, looking at the Moderna share price, the trend's not in its favour at the moment.
Yeah, I think I'd probably be in the same camp as you on that one. I think the amount and degree of policy uncertainty that the new administration introduces, particularly in the healthcare sector, is probably going to see some relatively stiff headwinds facing the sector over the short term until we have more clarity on exactly what the Trump administration are going to be doing. Obviously, I don't want to turn this into a political podcast, but I think personally it's one that I wouldn't be touching just yet, I don't think.
Yeah, I mean, it hit record low earlier this month of around about $35. But when you consider that it was just going back to 2021, it was $490.
Well, I mean, I'm not a pharma or biotech expert by any stretch of the imagination, but just at pure face value, a huge chunk of their revenue has been taken away because everyone's had their COVID vaccines.
Yeah. And I think there's fewer people taking them now. So they're only available now, I think, to an older cohort, of which I am not part of, before you say anything.
I was about to say, when's your appointment?
No, well, I could see that one coming, because I looked in your face and I thought he's going to ask that question, so I'm going to nip that one in the bud. So those 2 articles are on the Good Money Guide website, certainly worth a read, and certainly I think a great deal of food for thought. There is one more piece, and it's quite topical actually, because it's about when politicians fib, shall we say. I'm not going to say lie, fib, when it comes to whether or not they're going to raise taxes or not. And Robin Amos has gone into great detail, going back to around about 1985, 1990, when prime minister, which recent prime ministers have fibbed about tax? All of them. Oh yeah, I mean, all politicians. Yeah, I'm not going to say.
That's their sort of modus operandi normally.
It is, but I mean, I think there's there's been misled or misdirection, and then there's really being outright misleading. And I think the main concern an awful lot of people had about this particular administration is they came to office on a promise not to raise national insurance, not to raise income tax, not to raise taxes on working people. Well, if you pay tax and national insurance, you're a working person. So, you know, I think it's obfuscation, if you like, if you say that increasing employers' national insurance is somehow not raising taxes. Anyway, I mean, basically, Robin's gone through all the key protagonists, shall we say. Number 10, Keir Starmer, Rishi Sunak, Boris Johnson, Theresa May, David Cameron, Gordon Brown, Tony Blair, John Major, and Maggie Thatcher, all the way back to 1979. But I mean,
Do you know what
it comes down to the fiscal situation as well.
It does, and I would make two sort of comments or thoughts on that. I think the first thing is, firstly, the number of people who've held high office since over that period is frankly ludicrous, which shows particularly in recent years the level of political upheaval that we've had here in the UK. But the other thing I would say is, particularly in terms of the here and now. Rachel Reeves was out again this week saying, I'm not going to come back for big tax rises and all the rest of it. And the big thing that I think's flown under the radar since the budget is, there's a lot of people talking about inheritance tax, rightly so. There's a lot of people talking about national insurance, rightly so. The big concern I have is that all of the measures in the budget, according to the OBR's forecasts, leave us with about £15 billion worth of headroom, which in fiscal terms is effectively akin to pocket change. So if we have one relatively minor macroeconomic shock, or the OBR's forecasts are inaccurate, as they tend to prove to be, Rachel Reeves is going to have no choice but to come back for either more tax hikes or more government borrowing. And I think that is the big concern, is that, yes, we've had a significant tax raising budget. I think it was the biggest ever in nominal terms, at least. But that is probably not going to be the end of it, because we still have as a country a very, very limited cushion against further economic shocks.
Well, you're also assuming, Michael, that the budget raises the amount of money the Chancellor says it will. And I'm not convinced that it will, because you're assuming that the rate of employment remains the same and that companies employ the same number of people 1 or 2 years hence than they do now. And yet all of this week, we've had companies announcing that these additional measures are going to cost them extra money. Kingfisher earlier this week, if you looked at in their numbers, estimated that recent increases in not only the UK budget, but a French budget will cost them £45 million extra. Now, what was particularly telling about that was that they expect to mitigate that with structural cost reductions on productivity gains. Well, that's code for job losses for me and automation.
Yes, so, you're absolutely right. Do you know the other interesting thing that came out this week from the CBI? And I know the CBI have come in for a lot of stick recently, and probably the majority of it has been justified. But they did a survey of a number of UK businesses, and just to speak to your point, 50% of respondents are now looking to cut jobs since the increase in national insurance contributions was announced, and 66% of respondents are reconsidering their hiring plans as a result of what's been announced. So, we hear a lot about these large corporates, as you said, Kingfisher, Marks and Spencer's, Sainsbury's, a number of others have mentioned in their earnings recently. But it's going to affect businesses of all sizes up and down the country.
And ultimately, in periods like this, you obviously also get companies looking at consolidation. And there is a story in the news this morning where Aviva, which was also one of Darren's picks in his UK stock market article, has made a £3.2 billion bid for Direct Line. And I think that for me is actually quite an interesting story, because it's not the first time that Direct Line have been in the crosshairs of a bidder. I mean, albeit it was an overseas bidder. I think it was the Belgian company Ageas or something like that earlier this year. Now Aviva's coming in. Um, I think it's probably a better fit. But I think for me, there are going to be competition concerns, and certainly when it comes to their domestic business, because Amanda Blanc, CEO of Aviva, has been looking to very much focus on UK as one of their core markets. She's been getting rid of some of their more loss-making overseas markets in recent years. So I think going forward, that's going to be very interesting to think what the CMA will make of this particular bid and whether or not they'll attach any conditions. I mean, Direct Line have rejected it, so it's now incumbent upon Aviva to come back.
Yeah, I did find it slightly amusing that Direct Line rejected the bid, saying it undervalues the company. For those who haven't seen the news, Aviva's bid was a cash and share offer with an implied price of 250 pence per share. Direct Line closed the day before the offer was disclosed at 159 pence per share. So they were offering a significant premium in any case. You do wonder whether this will get over the line. Of course, it is the second takeover offer in the space of a year. But even if it were to be agreed between the two companies, I think the CMA are certainly going to have something to say before they sort of wave the green flag and let this deal go through. And my yellow card's coming out again, isn't it? Oh, it's a red one this time.
We've already had two yellows, so
I think it's more than two at this point.
Yeah, I think it is.
But you know what? In all seriousness, it is interesting, and it is good to see the pace of deal making starting to pick up a little bit in London as well. There's been a big sort of spate of foreign, particularly US private equity firms coming in and scooping up companies that are listed in London for relatively cheap valuations. And I just wonder whether this is perhaps the start of perhaps a sort of longer period of consolidation between UK-based companies as a sort of defence mechanism against those potential foreign takeovers, which, as you rightly said, in the Direct Line case, were rebuffed earlier in the year.
Yeah, I think the only concern that I have about this is obviously car insurance tends to be a fairly competitive market. In recent years, people have been complaining about premiums going up quite significantly. I mean, I've been one of them. My own car insurance premium went up 70%, and I didn't even have an accident that year, and a lot of people, were sort of citing the same thing.
Sorry,
You've got
the way you said that, an accident that year, it sounds like it's a regular occurrence for
Well,
you,
it's
mate.
not. I mean, I've got a no claims bonus that goes back 10 years plus. Um, but for your premium to go up by 70%, it's a little bit of a shock to the system because who doesn't own a car? There's very few people who don't, and that's quite a significant increase to your outgoings on an annual basis. So yeah, I would broadly agree with you. But then again, that goes back to the fact the UK market is very undervalued anyway. So it probably makes it easier for Direct Line to become a target. But when you actually look at their share price and where it was in 2020, it's still trading at a significant discount to where it was then. And obviously it is under new management. And the new chief executive, Adam Winslow, has been announcing a restructuring, cutting 550 jobs as part of a strategy to save 50 million in 2025. So obviously there have been problems there, but the thing with Direct Line, it sets itself apart from every other comparison website out there, and I think that was one of its USPs, if you like. So I think there's a lot to weigh up. While I welcome the fact that M&A appears to be making a bit of a comeback, there's good M&A. It's like the Asda Sainsbury's thing all over again. The CMA turned that down, and even now that looks like an even worse decision now than it was then, rather, given what's happening with Asda now. But anyway, that's my tuppence worth for what it's worth.
Do you feel better now?
Oh yeah, well, you know how it is, Michael. Sometimes it's nice to have these little chats now and then, sort of chew the fat a bit. But I mean, that's my broader point. I think you look at an awful lot of these companies, where they were in 2020 or even 2015, 2016, 2017, they're all a lot lower now than they were back then. So anyway, I mean, we've sort of looked back at last week's week ahead, if you like, because we've talked about Kingfisher. I mean, their share price took an absolute nosedive in the wake of those numbers. And ultimately, I didn't think they were that bad, if I'm honest. I mean, they kept their guidance more or less unchanged. They shaved the top end a little bit lower. But for me, I think maybe the fall came about as a result of the higher costs for 25, 26, and the potential impact on margins there. I don't know. It's hard to say. Um, sometimes you look at a decent set of numbers and you can't explain why the share price drops 10%. And other times you see a really poor set of numbers and the share price rises 10%. Sometimes it's about expectations, I guess.
Yeah, no, absolutely. I think that's just a broader point, whether it be earnings or a macroeconomic release or whatever it may be. It is all about, at least the short-term reaction, how that figure compares to what the market had been expecting and what had been priced in advance. That's really the key thing to focus on for the shorter-term participants out there.
Okay, well, let's move on. There's another thing. Typhoon slipped into administration, and Typhoon Tea slipped into administration this morning. So that's another UK company that's struggling as a result. And please don't make a tea pun or joke.
Well, I don't drink tea, so there's no puns coming there.
Okay, brilliant, excellent.
Sorry to disappoint.
Not disappointed. Quite sigh of relief. Okay, so that's basically looking back at the week. There was nothing in the Fed minutes that caught your eye, was there?
No. Well, there was, and it was a very, very, very technical thing, which is far too detailed for me to go into now. But no, fundamentally, the Fed are still data dependent. They are still taking a meeting by meeting approach. It was no surprise that the minutes of the November meeting said nothing of interest, given that the meeting came just 2 days after the election and 1 day after the election result was announced. That wasn't surprising at all. The technical tweak to which I refer was to do with the interest rate that is earned for cash parked in the reverse repo facility. That is a very, very technical thing, and actually I think will become a bit of a non-event as we move into the first part of next year and the Fed wrap up their balance sheet runoff anyway. But that was really the only thing. I think the minutes were one of those that's really one for the purists, and market participants more broadly can sort of safely ignore them and move on.
Any inflation numbers? Nothing in there?
No, not really. A small tick up. Headline PCE up to 2.3 from 2.1. Core up to 2.8 from 2.7. Of course, these annual rates that I'm quoting there. But really, I don't think that matters too much. One, it was all driven by energy. And two, the Fed are focused on employment rather than inflation for determining what they're going to be doing next. And I think in light of that, the next jobs report, which is, of course, due next Friday lunchtime on the 6th of December, that's really the key as to whether the Fed deliver another cut in December or not. I think they will. I know you don't think they will. Markets price it at about a 70% chance at the moment.
Well, that actually segues us nicely into the week ahead.
And it's almost like we rehearsed this.
Yeah, exactly. US non-farm payrolls for November. So as a quick précis to that, obviously October was a poor report, 12,000. Expecting to see a decent bounce back on that, Michael?
Well, you'd expect so. I mean, I think it's important to caveat that, yes, October was poor and yes, it was only 12,000. But that was because of a number of one-off factors. You had 2 hurricanes impacting that number. You had strikes at Boeing, and that would obviously impact not just the company, but also a number of firms within the supply chain, and also some automaker strikes as well. So I think a lot of that weakness will be unwound as we get the November data. So that alone should add, 100,000 to the non-farm payrolls print. So, I'm not sure where consensus sits at the moment, probably just around the 200,000 mark. I would expect that headline non-farm payrolls growth is relatively solid, that unemployment holds steady enough just north of 4.1%, and fundamentally that there's really nothing in the data to deter the Fed from another cut at the December meeting on the 18th.
I mean, I'm looking at the sister report for the non-farms, which is the ADP payrolls report.
No.
A few years ago, a couple of years ago, they changed the methodology of that so that it more accurately reflected, and I'm doing quote marks there, more accurately reflected the non-farms, because people are always complaining about the fact that is one a leading indicator of the other, is, which is the more reliable report. Obviously, ADP is private sector, even though non-farms does have a private payrolls component. And that rose to 233,000 in October, even though non-farms fell to 12,000. Both of these are expected to see fairly decent numbers in the November report next Wednesday for ADP, and I think next Friday for non-farms. But do you ever look at the JOLTS numbers, Michael? Because the JOLTS numbers tell me an awful lot more about maybe the state of the economy than perhaps the jobs report does.
Yes, I would agree. I think the JOLTS figure, which for our listeners who are unaware, that's the number of job openings, effectively vacancies in the US economy, and you also have things like the quits rate and things like that. It is something that I pay attention to. The only problem with it is a 1 month lag between the data being sort of the reference month, for want of a better word, and the data being released. So, the non-farm payrolls number in the employment report, it is far from a perfect survey. And yes, the data gets revised on a number of occasions between its publication and the sort of final reading. But it's the best and the most timely gauge we have of employment conditions in the US labour market. The one thing I would say, whether it be the official labour market data, whether it be the JOLTS report, whether it be the nonsense ADP number, or even the PMI surveys, they all tell the same story, which is of a labour market that is slowly but surely loosening and slowly but surely normalising, rather than the one that is sort of crashing and burning and that necessitates any more forceful easing from the Fed.
We've got jobless claims numbers at a 7 month low. We've got the JOLTS report are still well above where they were pre-pandemic. 7.44 million. Yes, they have come down from 13 million, but they're still above the levels they were pre-COVID, which suggests to me that there's still quite a bit of slack in the US labour market. So yeah, okay, but cut rates by all means, but are you sure a rate cut's really needed at this point in time? I'm not sure it is, particularly when inflation, not only in the US, but also in Europe, is starting to edge higher again.
Well, of course, we've got the latest Eurozone inflation figures due tomorrow, Friday, for our listeners out there. They are likely to tick higher in November, that data will be for. But I think, in Europe, there are bigger issues than inflation, and that is that the economic growth is stalling at best. And also now you've got the French political shenanigans coming back onto the radar as they try desperately to try and pass some sort of a budget without the government collapsing. So I think there's probably bigger fish to fry in the Eurozone, at least. Stateside, I think, I would refer listeners to our earlier discussion, which is that I would argue we're still in an emergency policy setting and we don't need to be anymore.
Well, that sort of segues into the services and manufacturing PMIs for Europe next week on the 2nd of December and the 4th of December. And they're not likely to make for particularly agreeable reading when it comes to the ECB. And when you've got Spanish inflation as well, edging higher, and you've got services PMIs and manufacturing PMIs in contraction territory, the ECB's stuck a little bit between a rock and a hard place.
It is, very much so. The question I would ask you, and you've characterised particularly the manufacturing sector as being in depression in the Eurozone, and I would agree with that description of things. The question I would therefore ask is whether the ECB do nothing, or cut 25 basis points, or cut 50 basis points, or come up with some sort of other acronym that they love to come up with for another monetary policy liquidity programme. Is it going to make a blind bit of difference? I would argue it won't.
In that case, why bother cutting rates at all?
Well, there you go. I think the problem with the Eurozone is it is a very, very exposed bloc from a trade perspective, and the Eurozone's major trading partners are struggling. You look at China. There is no discernible sign of an economic recovery in China. We have PMIs due from there later on this week, and fiscal stimulus in China is targeted at propping up the stock market rather than helping the macro economy. So I think the Eurozone's problems are numerous, and Christine Lagarde, I'm not her biggest fan, but actually maybe you feel a bit of pity for her because whatever she does is not really going to make the blind bit of difference.
Yeah, but aren't all stimulus measures implemented by central banks designed to prop up the stock market, Michael? Let's be honest about this.
Well, yeah, that is very true to an extent, yes, and that's why the central bank put that we talk about so often exists. But yeah, that's probably a topic for another podcast, I think.
Well, we've got a few weeks to go, and we've also got UK manufacturing and services PMIs as well on the same dates. And again, here, even though while the UK is outperforming Germany and France, services the services PMI slipped to a 13-month low of 50 in the flash numbers only I think it was a week or so ago. So again, sentiment in the services sector, which generally makes up around about 80% of UK economic activity, is flatlining now.
Yeah, and I think that is a real concern. Actually, I mean, we've spoken at length about the issues in the manufacturing sector, the services sector, particularly here in the UK. That the PMI, the flash reading was a 13-month low. You'd expect the final reading to confirm where the preliminary estimate had us, and I think that is a real problem. You look at economic momentum here in the UK over the last sort of 3 or 4 months, it really has fallen off a cliff. GDP grew by just 0.1% in the 3 months to September on a quarterly basis. And now you're talking about the October PMI having fallen, the November PMI in the services sector being in contractionary territory. Doesn't look like there's going to be much festive cheer on the horizon from an economic point of view. And of course, this comes as price pressures remain pretty stubborn.
I mean, you showed me earlier a picture of the FTSE 350 retailers index, and year to date, in September, the index was up 12.5%. Since then, it's given up all those gains, is now 2.5% down. I wonder why that would be.
Well, we're not allowed to get political, so no comment.
Well, I can just say that, and I've written about it in my weekly note. But basically, what I've said, the new administration proceeded to talk the economy down by talking of disastrous inheritances, fiscal black holes, along with fancy down sound bites about fixing the foundations. The purpose of a new government is to bolster confidence, not dynamite it into the ground, which is essentially what this government has done. So is it any wonder that people are worried about the pound and the pennies in their pockets when it would appear that this new government has about, the economic common sense of a sixth form college?
I mean, that's being slightly harsh on sixth formers, I
Sixth
think.
formers, yeah,
But
I know.
yeah, I do agree. And I think it proves that so much of economics is self-fulfilling. It may be politically expedient to come in and say that, things are the worst that they've ever been and our inheritance is terrible because we can blame the other side for all of our problems. But from an economic point of view, fine, you do that, but people are going to believe that things are actually as bad as you're saying they are. And as a result, you're going to see spending habits and consumption habits change. And that is exactly what has panned out in the UK economy over the last few months.
Yeah, we've certainly seen it in some of the performance from the retailers who've been reporting over the course of the last couple of weeks. And we may well see it next week with Fraser's Group when they report their sales numbers for the first half of this year. Now, Fraser's Group, you may not know, Sports Direct essentially comes under as the umbrella company for Sports Direct, Evans Cycles, Gain, Jack Wills. Mike Ashley seems determined to take over the high street, and it looks like he could well succeed because ultimately I think valuations could continue to come under pressure if people continue to perhaps be reluctant to put their hands in their pockets and buy these sort of what I would call discretionary items.
Do you know what I think is interesting, and this isn't something I've followed as probably as closely as you have over recent months. Is going back to what we were saying earlier about the CMA.
Mm,
Mike Ashley is buying half the high street, and I
mm.
haven't. And maybe I've completely missed it. It's passed me by, but I haven't seen much by way of competition concerns about that.
That's an interesting point, actually. I'm guessing because an awful lot of these retailers don't overlap each other in terms of the products they sell. So
Hmm.
you've got Jack Wills, you've got Game, you've got Evans Cycles. So, Evans Cycles competes with Halfords.
Yeah.
Games competes with Game Workshop, which has done very well this year, like the makers of Warhammer and what have you.
Hmm.
And now he's interested in getting involved with Boohoo. Um,
Yes.
and that's becoming a little bit tasty, shall we say, when it comes to,
As most things involving Mr. Ashley seem to.
yeah, indeed. So I haven't really seen any sort of any, and there's Jeeves and Hawks as well. So
Hmm.
none of these retailers, there isn't really an overlap between them. I think he wants to become the Harrods of the High Street. I think someone said that once a few years ago. I don't know who said it, and forgive me, I can't remember, but it's not a bad analogy. Um, but certainly, I think this time last year, group revenue for Fraser's Group saw a 4.4% increase to 2.77 billion in the first half. Be interested to see whether or not they're able to match that number, and ultimately how he sees the future. And one of the things that I have noticed is he hasn't been particularly vocal about the
It's true,
recent
actually.
tax measures in the budget, and that's unlike him because previously he hasn't been backwards in coming forwards when it comes to criticising chancellors of the exchequer.
Do you know what? That's actually a very good point. I hadn't sort of even thought about that. Maybe the post earnings call is the perfect opportunity for him to break that silence because, clearly he is a significant, if not the most significant player in the UK retail space at the moment. So, it'd be interesting to see what he has to say because obviously there's a number of issues facing the sector, not just the stuff that, everyone's been talking about in terms of national insurance contributions, but business rates are another thing that has really flown under the radar. They're going to be going up significantly in the new tax year as the holiday comes to an end there. So it'd be interesting to see if he has any comments on that as well.
Well, apparently there's a letter from UK airports going into the Chancellor about that very topic. I think from 2026, because apparently they're going to be going up by about 5 times what they
Jeez.
were, and that's going to have a significant impact on jobs
Hmm.
from 2026 onwards. I was reading that somewhere. I think I saw it on the Sky News website, something that was put out by their business editor. So, be interesting to see whether or not that letter goes in and
Hmm.
what the impact of it is. Okay, we're going to wrap this up because we've got two more companies which might be noteworthy next week. Balfour Beatty, third quarter numbers, and CEO Leo Quinn. Balfour Beatty's share price pretty much done really well since it sort of rallied in the wake of obviously the Carillion collapse and what have you. Focused very much on high margin work and got rid of all the low margin stuff. Pick and choose, and it's done really well. And they've announced two further contract wins in the last 3 months. So the omens for that look good. And we've also got Barclay Group, which is obviously a house builder here in the southeast. Be interested to see what they have to say about the state of the housing market going forward.
Yes, indeed. And of course, housing being one of the government's key priorities to sort of get Britain building. I think they said 1 million houses over the 5 year term of the Parliament. So, they need to get house builders
Yeah,
on
that's
board
not going
and
to
try and
happen.
achieve that. Oh, ever the cynic, mate. But no, of course it's not.
I know you'd have to change planning rules to make sure that happened. It's the planning system that's really, I think, you know, the the cork in the bottle really
Hmm.
there. If you want to build um, as fast as this government needs to, you're going to have to tear up the planning rules. And yet, on the other flip side of that, you've got people complaining about flooding and what have you. Well, if you build houses on floodplains, what do you expect?
Yes. Shall we keep that for another
Yeah,
podcast as
we'll
well?
keep
That,
that for
that
another
list is
podcast.
getting ever longer, I think, isn't it?
Yeah, indeed. So anyway, that's it for this week. As I say, I mean, in the next few weeks or so, hopefully Michael and I will have a look back at some of the key sectors that have done well this year. Um, Key staples like retail, banking, energy, and we'll
Hmm.
also look at currencies as well and maybe the prospects for the pound going forward as we head into 2025. Anyway, thank you very much for listening. Thank you, Michael, again for your
Thank you, mate.
insights. always entertaining, always valuable, puns notwithstanding, and we'll see you the same time, same place next week.
Goodbye for now.
Cheers.